It's a pause in rates, not a pivot, said RBI Governor Shakti Kanta Das, and fairly vehemently at that when the press conference ensued after the announcements made in the Monetary Policy Committee. The Reserve Bank of India has hit the pause button after 6 consecutive hikes in repo rate since May last year in a bid to battle inflation. RBI has said that core inflation remains sticky, but the Monetary Policy Committee projects retail inflation to moderate to 5.2%. After rising interest rate by a cumulative 250 basis points in the last 11 months, the benchmark rate has been left unchanged even as global banking woes add uncertainty to economic outlook. The RBI 6-member Monetary Policy Committee voted unanimously to keep the repurchase or repo rate unchanged at 6.5%. Most analysts had in fact expected one final hike of 25 basis points in RBI's current tightening cycle before hitting a pause. The MPC also decided to retain a policy stance focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. That has been the approach that the RBI has taken ever since it started tightening in May last year. Our job is not yet finished and the war against inflation has to continue until we see a durable decline in inflation closer to the target, Das said. What does this mean for India's growth, India's consumption amid an inflationary environment, interest rates and markets? Joining me to discuss this and more, economist Karan Mehrishi, senior journalist Subhomoy Bhattacharjee, and in my studio I've got my colleague Rakesh Khar joining me as well. Before we get to this esteemed panel in just a bit, let's listen into the highlights of what the governor said during his announcements at the MPC.
What we are witnessing today is unprecedented uncertainty in geopolitics, economic activity, price pressures, and financial markets never seen before. Once again, one can imagine the magnitude of challenges central banks and other policymakers face in today's world. The Monetary Policy Committee met on 3rd, 5th, and 6th April 2023 and assessed the macroeconomic situation and its outlook. It decided unanimously to keep the policy repo rate unchanged at 6.5% in this meeting with readiness to act should the situation so warrant. The real GDP growth for 2023-24 is projected at 6.5%, with Q1 at 7.8%, Q2 at 6.2%, Q3 at 6.1%, and Q4 at 5.9%. The risks are evenly balanced.
The risks are evenly balanced, said Shakti Kanta Das, the governor of RBI. Let's go straight to Karan Mehrishi. Karan, markets have, of course, given a thumbs up, and there was, of course, some selling that we saw earlier in the day when people were trying to book profits ahead of the MPC, given the expectations that most analysts had on a 25 basis point increase. As an economist, how do you see this pause in the stance that the RBI has taken?
Thanks, Kartik, for having me. So, first I would like to talk about what reluctant MPC members have been saying, which is a primary reason for today's pause. Now, industrial activity, Kartik, especially manufacturing, is still at a nascent state of recovery. The phenomenon is now confirmed by Q3 financial year 23 numbers. Data reveals that based on Q2 FY 2023 results, EBITDA for Indian manufacturing enterprises has actually fallen, first time in 2 years. At the same time, EBITDA to sales ratio is now the lowest in 3 years for all enterprises in India. So unsurprisingly, this corresponds to a period when the counter-cyclical monetary stance was adopted and is happening when commodity volatility is significantly contained in India. So now there is a possibility that a combination of rate transmission and moderating consumer demand is at play here. Now, what are the repercussions of continued high rates in the system? And that is the reason why the MPC was actually reluctant today. For starters, continued high interest rates is potentially a lethal situation for economic stability. in the current environment. This is because non-rationalization of the GST rates on essential items may subject households to a liability of incidence of tax, which is under the tax shifting theory in economics under perfect competition, as enterprises eventually offload the entire incremental input burden onto the consumers. The understanding is that fundamentally enterprises must earn normal profits in the long term, spawning inflationary pressures for the households. Now, this can potentially, this is very important, Kartik, here, is that this can potentially kill the consumption story for India, which is a primary driver for growth. Now, if I quote Ashima Goyal, a dissenting voice in the MPC committee, she says a sharp rise in real policy rate, substantially above unity, triggers a shift to a lower trend of private investment and growth. Then the sacrifice ratio of disinflation can be very high, as it was in the 2010s. Over-tightening today does not necessarily improve the future. Inflation can rise over time because supply bottlenecks worsen. So I think forced recession can at most subdue inflationary tendencies in the short term, stoking inflationary demons to reappear later. So the fact of the matter is that the RBI is forcing, or rather had been forcing the Indian economy to return to a recessionary phase when the business cycle was yet not complete. So that is my assessment for today's pause.
Right. Subhomoy, you had joined us a couple of days earlier on this very broadcast, and you were one of the naysayers who said that that a pause could be likely. And in fact, while most analysts were saying that a 25 basis points increase is likely, you were one of the few voices who said that the RBI might actually go ahead and pause it. So what were you thinking then, and what is your immediate reaction right now?
Well, basically, I mean, like what we are discussing right now is absolutely correct, that the MPC verdict is basically getting more and more fractured, which is what happens. You see, when a particular trend is happening, like supposing the trend is rising in a particular side, then obviously you would expect all the MPC members to be on the same page. But as the inflection point comes along, then differences in opinion comes along. Just as you would have found out when you were talking with experts and analysts about what should be happening, and the decision, sort of the expectations start veering off in different directions. Right. So when I'd say that it will be basically, I mean, I had expected that they will take a pause. My point was that the number of naysayers in the MPC is rising. And now, as you can see, that, four of them, for 5, have remained focused on withdrawal of accommodation to go along. And I think that is the important part. The fact that they have decided to keep a pause doesn't really mean that they have decided to take their feet off the brake. They are still saying that if necessary, inflation, they will, even at the mid-course correction, and the RBI has often done it, they might be willing to do that mid-course correction if they think the data is looking uncomfortable and needs again to raise rates to keep the inflation pressures under control. So, yeah.
Right. So stay with us, both the gentlemen, and let me take this conversation to my colleague Rakesh Khar here with me in the studio. Rakesh, 6.5% growth is what is projected. This, of course, is pretty much in line with what the World Bank or the ADB have also said, 6.3 and 6.4 respectively. In the present economic scenario, a 6.5% growth, does it seem likely? Does it seem possible?
At the macro level, Kartik, I think, first of all, we shouldn't be too, sticky about the forecast that these economists make, including at the RBI. They have a very difficult and challenging job to do simply because we live in an extremely uncertain world where the control on variables, known and unknown, is very, very low. So in that sense, I think the RBI policy today is very, very nuanced. It's mature, it's playing safe, and I think by and large we should be able to make virtue of the target that has been set in GDP and also on the inflation number. I would summarize the policy to begin with, Kartik, as it's a please-all kind of a articulation that the RBI governor has said. It is pleasing a huge constituency which is asking for, including MPC members, which is asking for growth to be, so to say, given a chance. You remember one of our shows, Swadeshi Jagran Manch President Dr. Ashwini Mahajan raised the issue of RBI not going in for another hike. So there is a growth constituency, which is a strong constituency, which I think it has adhered to. At the same time, the RBI governor has also not let the guard off on the inflation issue. Remember, we are in an election year. We have 6 or 7 election states, Karnataka next month. So inflation is an election issue without doubt. How it gets panned out is a matter of how politicians deal with it. But I think there would be a concerted effort to say that inflation is also extremely important, as is evident from various statements that the RBI governor and his team made, and growth is equally important. And the fact that he said this is a pause for now, I think that's a very valid reason, though he was pressed into by our friends in the media repeatedly to try and give a timeline. He said, you can't time me or tie me. I think that's a fair statement to make, Kartik.
Right. So let's stick to the issue of inflation, which you've raked up very correctly. So, Rakesh, and let me take this conversation now to Karan Mehrishi. Karan, inflation target of 5.2%. Here the assumption being that oil is going to stabilize at $85 per barrel. The other assumption that the MPC has taken into account is a good monsoon. We've seen unseasonal rainfall. We've seen OPEC cut down oil production. We are talking about an El Nino-like situation again. So are these assumptions on inflation accurate, and how much do you think of this will actually help cut down inflation to 5.2?
Well, I think inflation is sticky, especially the core inflation.
Yeah.
So I think the RBI and the MPC is right to not cut inflation expectations because, as the governor was mentioning, OPEC Plus has cut production, and that is something that will have a significant impact on inflation expectation of households in emerging markets. So I think that at least for the next 2 quarters, inflation will remain sticky, given the fact that supply chains have not yet completely stabilized. And the commodity prices, especially crude, will be pretty high and volatile. The prices of crude. Now, as far as the inflation expectation for the entire year are concerned, then I think the 5.2 to 5.4% range is kind of accurate as it appears from this vantage point.
Okay, Karan, Subhomoy, do you agree with Karan there, and especially in the context of oil? Is $85 a right assumption to make right now in our calculations? And of course, the monsoon situation.
See, the oil price pass-through is always a difficult thing to figure out. The India government budget doesn't use the oil price pass-through. The monetary policy uses the oil price as a part of its calculation. Now, how would the oil prices come out? 85 seems a very reasonable price to say. Basically, why?
So I'm comparing this, Subhomoy, I'm comparing this to, let's say, the World Bank's estimate of $88 to $90 per barrel, and many estimates also suggesting it could go as high as 100 per barrel. So keeping these projections in mind, does 85 seem like too optimistic a number?
No, it doesn't. I'll tell you why. Because all the RBI numbers come with a band. In some cases, they publish the band. In some cases, they don't. So 85 would mean a range of something like 83 to 89. That is what the RBI would be doing, which is fair enough. I mean, that's more or less what you expect. Also, remember, this is an average for the year. This is not about month to month. If you look at the annual rate of average prices of oil over the last few years, it'll be surprising how much it is actually different from what the peak prices are actually often are. So even in years when peak prices have gone up to 110, the average has been about 90, 91. So average of 85 is a very good average, which means that it's taking in a fluctuation of a range of going up to even 100 to 105.
Okay.
And if the world economy softens because of recessionary fears, then it can actually even come down to well below 80 to something like close to 75 or 78. So therefore, 85 is I would say, a very decent rate to factor it in. Also, that is not the only reason why inflation happens. Peculiarly, the exchange rate of the Indian rupee, while it stays stabilized against the dollar, it tends to move adversely nowadays against the euro as well as some of the Asian currencies.
That's right.
Now, that's why does it happen? It's because of the commodity prices. Who exports the commodities?
Right.
Now, those commodity price effects do not always reflect through the US dollar for various reasons. And that is why you would find that, for instance, in the current circumstances, the Indian rupee is doing very well against the dollar, but it's not necessarily doing well against the other hard currencies. So does that create a problem? Yes, it creates a problem. What sort of a problem? It makes inflation projections difficult. What RBI has done is say that, look, I am seeing overall a softening of the vegetable prices, of the cereal prices.
Right.
So therefore, despite the late rains and others, so I would expect the price, sort of say, the movement towards downward.
Got it.
How much downward? Well, they're still taking it at 5.2, which means basically they're saying it's a range between anywhere between 4.67 to 5.78, which again is a very safe estimate to make in the current circumstances. But the fact that the five of them have said that we are voting for the accommodation issue is a very good indication that even RBI, despite making all that assumptions, is still saying that, look, I am not very sure that these numbers will pan out exactly as they are. You need to see it for at least one more quarter. And remember, one of the interesting things that's happening, milk prices are rising. Milk is surprisingly a very good indicator of high prices. It pans through in India across several food products. So the impact of a weak flush last year in milk, which meant that there's a milk shortage developing now, can actually be something which will make us discuss inflation in terms of milk rather than in terms of oil pretty soon. So yeah, over to you.
Right. So, Rakesh, talk to us about the geopolitical environment that we are living in, and talk to us about what is happening in the US banking system and the fears of a looming recession in the US, which sort of completely refuse to be faded away in any conversation. What impact is that going to have on India's IT exports, for example, or on other services, the back offices that India runs? What kind of a pressure, or what kind of a recession in export can we expect, and how's that going to pan out for economic growth projections at 6.5?
Kartik, first of all, I think the RBI governor in the press conference made a very subtle statement when he was asked how is the banking system in terms of the regulatory framework. He also used the word "so far so good." So I think, that was interesting, because I personally felt that they might make a summative statement saying that we've done pretty well, which is a fact as well. But as I have been saying, you've been saying, the discourse in the media and the public policy is that it's so far so good. I think that's a safer way of looking at it, because we live in an extremely connected environment today. We cannot isolate or insulate ourselves. That's the policy that this government has adopted and should rightly have adopted, because when you connect with the external environment, then only your entire economy is in that manner, in a growth-oriented trajectory, with all the accompanying challenges that you are mentioning about. Right. I think I was reading The Economist. It used a nice sentence for the banking system there, for the Fed, when it said, the Fed is trying to fight last year's battle with an ideological dogma and no further. So meaning that, the Russia-Ukraine war, that time they were sleeping, and suddenly it's moved from 1 to 5% rate of interest. So in that sense, our banking system, and RBI in particular, has done a fairly good job, and they kept their eyes on it. How does the export-import scene pan out? I mean, let me begin with milk. I think milk is a very, very manifest category, in whatever bucket you put it, but it impacts us all, and we consume it in various avatars. So that's a worry, and that's an inflation worry. And I read somewhere today, I don't know how authentic the report is, that India is planning to import, stuff so that, we are able to moderate prices. On overall macroeconomy of exports, I think the good part is that we have diversified the portfolio. These are early days for services exports, and government itself is keen to admit that the recessionary trends would hit our traditional exports, that's the IT, in some way. I don't think there's a figure doing the rounds. They've stuck to that 1 trillion of exports for merchandise and 1 trillion for services, which I think is pretty ambitious as of now. I don't think they're getting down on any numbers to specify right now, but it will take a hit because recessionary trends are visible all over, and that's the scene today. We don't know how it's going to pan out tomorrow.
Absolutely.
There are a lot of unknowns. The OPEC cut is come out absolutely like a shock. We really don't know what turn the war will take. So we must be ready, and I think the RBI has given that assurance today that it's keeping a hawkish eye on the environment, at least in the articulation. The strategy will unfold as it meets again.
Right, so a lot of shocks for everybody to absorb, especially the RBI and the citizens as such. But Karan, specifically on IT exports, how do you see it pan out? If there is a recession and if there is a collapse in some sort of the banking system globally, and the back offices being the Indian IT companies, what kind of order books and impact on export volume do you see?
So, Kartik, as far as overall services exports are concerned, they're pretty healthy, especially given the fact that robust performance has been recorded from the GCCs. And IT exports are pretty much run parallel with overall capacity expansion as well as capital intensivity in industry. So I think that is what we are seeing in the developed world at this point in time, especially the US and Western Europe, where capital intensivity is now rising. So I think as far as order books are concerned for IT companies, they look pretty healthy right now. And I am quite sure that India will be able to meet the target of $1 trillion by 2030 as envisioned by the government of India. But overall, Kartik, as far as the higher rates are impacting growth, as you were discussing, I am very much concerned about the fact that the policy rate is now higher than the GDP growth rate itself. Now, as we understand, the real Q3 number comes at around 4%. What this means is that based on estimated numbers, the policy rate now exceeds the subsequent quarterly real GDP growth number by almost 100 pips. When this happens, debt repayment capacity of both the government as well as the private borrowers will be significantly impaired, and economic hardships are encountered. And these are generally lingering in nature. So the last time, if I talk about a historic perspective, the last time the situation was encountered was between Q4 FY19 and Q4 FY21. And the differential was around 570 pips, primarily on the back of the massive economic contractions in FY21. Right. Interestingly, the previous GDP growth policy rate anomaly occurred after completing the entire business cycle of 13 quarters. Now, 13 quarters is a business cycle that is empirically proven by the RBI economist department. Now, the trouble is that the anomaly underway at this time has occurred just after 6 quarters. So, given the timing, I suspect that the monetary authorities have not given the economy enough time to recover lost capacities and impaired supply chains. So that can actually make the volatility much more entrenched than previously thought.
Okay. So what can be done at this stage? Because you obviously have a higher cost of capital. Subhomoy, let me bounce this to you. There is obviously a higher cost of borrowing, hence the cost of capital goes up. And GDP growing almost at the same rate as, in fact, at a rate lower than the cost of capital. How is this going to pan out in the Indian context? And can there be any steps that the monetary policy or the fiscal policy need to take to ensure that we don't find ourselves caught in that grip?
That's an interesting point. Today RBI has also released what is called the monetary policy analysis, rather than the monetary policy statement. If you look at page 39 of that, you'll find that the interest coverage ratio of listed private companies in the manufacturing and information technology sectors have remained comfortable in third quarter of 2023, indicating adequate debt servicing capacity. But this is very interesting. It means that despite whatever is being talked about the cost of capital and all the others, the companies of both manufacturing and we were recently talking about the IT sector and the information technology, it's mentioned specifically, that has remained comfortable, which means that the cost of capital for them has not necessarily worsened in the period of the rising interest rate. This is data. And that data, therefore, makes it a very good base for us to understand how investment will pan out. If you also look at that, along with what the government is doing about the role of public investment, and the RBI, again, report goes into analyzing the public investment multiplier on private investment, it concludes that the multiplier for public investment on private investment is more than 1. And on overall GDP, it is 1.7 over a 3-year period, which means that both the government's push for infrastructure investment as well as RBI's position on interests has actually been what should one say, and what from the fiscal policy side, it's actually been positive. And from the monetary policy side, it has not been negative. It has been neutral. Again, as I said, the interest coverage ratio remains comfortable, indicating adequate debt servicing capacity. And if you look at the chart of the tables of the data of what is it happening, the ICR of these sectors has not worsened. In fact, the ICR of the interest coverage ratio of services sector has improved. What is this interest coverage ratio? It means the ability of a company to pay interest on the debt that it is accumulating. So this is a very significant analytical framework on basis of which we can look at what is happening to the cost of capital in the economy. So therefore, I would say that actually RBI is coming to a fairly, what I should say, a thought through analysis of what needs to be done. That it was giving a pause on the interest rate, but it's just pausing. And the language is very clear that at the slightest sign of inflation hardening, it will go back to pushing up the inflation, to pushing up the interest rate.
Of course.
In that context, in fact, one of the things that it will be very interesting, and I wonder whether you can show it for your viewers. This is, again, that same document I'm talking about. This is the page 11 of that document, and there's a wonderful graph there. The impact of risk scenarios on the baseline inflation path. Now, if you can look at both chart A and chart B, you would notice that the effect of crude on as a shock to the economy is actually projected to be much less. It's actually tamping down with the growth rates. Whereas the effect of food inflation is much higher. And that is, and RBI's projection is that inflation will remain high through the entire quarter of 23-24. Now, through all the 4 quarters, coming down only by the end of the 4th quarter. So, which means that this is going to be the biggest worry for the RBI. And because, as I say, the crude prices are actually not expected to be a very big shock. So, the exchange rate depreciation of the rupee, which pulls in inflation from abroad, which we basically call imported inflation, that is not expected to be as high an impact on inflation as the impact of food inflation. These are very interesting, data charts to base our analysis on of what the RBI is thinking. That it gives a very good. What is the RBI saying? The RBI is saying that right now the inflation risks from abroad are possibly not very high.
Not very significant.
The inflation risks have actually become more from the domestic economy. And within domestic economy tends to be the food economy. And that is what is going to be something which RBI shall be monitoring very closely in the 4 quarters of this year. So that is how we should be reading the entire RBI policy today.
Right. So internal shocks, domestic shocks, especially with food inflation, not as much the external shocks of oil prices. In the context of this, Rakesh, if I can take the discussion to you, what do we do about India's consumption story? Because food, of course, is going to be an essential, and a lot of consumption-driven, purchases are going to be made, and foods, of course, being the most essential among them. So in this context, how do we expect private sector to make investments in non-essentials and hope for them to take off as well?
First of all, I think apart from RBI being worried about the food inflation, it should be a worry for the ruling dispensation, because if you close fourth quarter, Kartik, with high food inflation, then there is greater chance of it becoming and getting traction as an election issue. So that apart, I think what Subhomoy mentioned about credit offtake of private sector. He mentioned a couple of sectors. I don't know whether we have complete visibility of the overall credit offtake by India Inc. And even if there is, whether it's being actually parked into capex, into further building the capacity. So that is the macro picture. In regard to consumption, I'm reminded of an interesting inflation and consumption story when Chidambaram was the finance minister. I don't remember the year, unfortunately. So this issue about food prices, wheat prices going up. So he did come up with an explanation. I don't know how plausible it was, but it stuck as an argument that he compared the food habits of yesteryears with the year that the issue was under review. So he mentioned, हम पहले 2 रोटी सुबह खाते थे, शाम को 3 रोटी खाते थे. The consumption category in food has changed so much. Now we also eat a burger, we eat a pizza, we eat pani puri. So he kept expanding the category. So in that sense, the appetite for food and its avatars is truly amazing. With an upwardly mobile Indian audience, especially the youngsters, you can't put a cap on their, their capability or ability to locate something really fresh given the internet penetration. So very difficult to cap food prices and very difficult to even reimagine food consumption from a government's perspective or from an inflation management perspective. The best and the worst thing that the government does anytime is imports. Yeah. So again, I have always maintained that we need a consistent agri-import-export policy. Since it becomes a political issue, what happens ultimately is that you buy at abnormally high prices and you don't do forward contracting and try and mitigate the political aftermath. So that might happen yet again as we go into the election year.
Right. So let's end this with you, Karan. Karan, in this whole story of a 6.5% growth, talk to us about the rural economy with food inflation being a worry. What is your outlook for the rural economy in this fiscal?
Well, I think Rabi output seems to be pretty much in line with expectations. Yeah. And as the governor was also mentioning, tractor and two-wheeler sales are quite healthy. And so one of the metrics that we see, to assess rural demand is consumer non-durables, and that category continues to be on a very healthy path. So okay. I think rural consumption at this the consumption story in the rural setting is still quite. I'm quite optimistic about the story, and going forward, it all depends on the El Nino effect, as well as how rural credit is impacted by the current impact on credit offtake, which will eventually take a hit as more transmission of rates happens into the banking sector.
All right, Karan, thank you so much for joining us. Karan, Subhomoy, Rakesh Khar, thank you so much for being with us on this very important news event of the RBI keeping the repo rate unchanged and pausing, not pivoting, as the governor said. And news and updates will continue on News 9. So if you haven't still, go ahead, hit that subscribe button so that you don't miss any update from us. Thank you so much for watching Business Plus. We'll be back again tomorrow.